You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is, of course, the program for you, the busy financial advisor who's looking for ways to implement options into his client portfolios, as well as for those of you out there who are maybe looking for a new advisor and I want to say, hey, what skill sets should that guy really bring to the table? Well, we're here to answer all of those questions for you. Of course, if you haven't done so already, make sure you check out all the latest additions to the Options Insider Radio Network. Of course, we have Options Playbook Radio. I'd imagine that would interest a lot of listeners of this program. It breaks down option strategies and some fun sports metaphors and some short weekly 15-minute nuggets if you want a quick check-in, a quick update, a quick refresher on some option strategies using some fun sports terminology. Then check out Options Playbook Radio every week on the old network. And while you're there, of course, check out our latest edition for some of the more hardcore listeners out there who want to know what's going on in the world of trading technology, how it impacts your trading. A lot of people up in arms post Flash Boys about the world of fintech, how it feeds back into the marketplace. Well, our show, Trading Tech Talk, carves all that up in a lot of great detail. Check it out wherever you find this program. And of course, while you're listening to all that stuff, make sure you head on over to your app store of choice. Could be iOS, could be Google Play, even the Amazon App Store. Of course, the new Amazon phone, you could use it for that as well. Of course, I'm talking about our Options Insider Radio mobile app. You can download instantly and stream all of the episodes of The Advisor's Option, as well as all of your other favorite programs on the old network. And while you're listening to a show, you may say, hey, I have a question about what those guys are talking about, or maybe I have a comment. I disagree with what the hosts are saying, or I agree. Whatever the case may be, you can hit that email button, hit that feedback tab, and you can shoot us a comment or a question in a lot of different ways directly through the app, via email, via Twitter, via Facebook. You can even leave us a voicemail directly in the app. It's pretty cool. Check it out, the Options Insider Radio Network mobile app. I think you're going to like it. All right, and joining me on the Advisor's Option today, starting off with my co-host here, my partner in crime, none other than Mr. Randy Swan, the co-founder of Swan Wealth Advisors. Randy, welcome back to the program.
Thank you. It's good to be here. This is a new new opportunity for me to participate in the program from my new home in Puerto Rico. I live in a town called Humacao, Puerto Rico, that's on the southeast coast of Puerto Rico, facing the Virgin Islands. So, as I said earlier, it's a consistent 80 degrees here pretty much all year round.
Go ahead and rub it in there, Randy, why don't you? It doesn't sound so bad now, but if you say that again when we're in the December to January timeframe here in Chicago, it might sound a little bit more mocking. I'll be much more jealous of you then, sir.
I'll remind you then. So noted.
All right. And also joining us, listeners, on this episode, we have a special guest co-host for the episode, Mr. Joe Cusick, the Vice President of Wealth and Asset Management over there at MoneyBlock. Joe, welcome to the program.
Hey, thanks, Mark. It's great to be on. It's been a while.
It has been quite some time. Of course, you made some appearances on some of our other programs in the network back in the day. In your earlier incarnation, you've, of course, changed things up a little bit over there, and this is, of course, your first time on this program. So why don't you go ahead and give some of our listeners to this program who may not be familiar with what you've done out there in the past, a quick overview of your background in the option space and how you found your way over there to MoneyBlock.
Yeah, sure, Mark. I've evolved from a market maker, and I do say evolve because once you leave the floor, you realize how little you actually did know. But went over to Options Express back when we kicked it off in 2001, and was an intricate part of helping build that platform. And really, what I was focused on is not only building out the platform tools and capabilities so that it met what I needed and what I was learning more and more of what I wanted to do, but also educating clients along the way so that they were no longer, as I consider them, dangerous, but they were well-informed and they could utilize all of the product offerings and the true versatility of the derivative product in a sense of looking at it holistically from a portfolio perspective. And I've took that experience over the last 13 years there and developing that both from a retail side, but also from an investment advisor side, because I was also actively involved and engaged as a money manager utilizing derivatives and with our entity Brokers Express. And, again, taking all that experience and then 3 years after Schwab acquired us, working within the Schwab network and learning a ton about not only the institutional world, but how Schwab approaches the retail world, I saw an opportunity to jump on with MoneyBlock and Trading Block and even build that out even further. And so right now I'm heading up, building out the SMA and asset and wealth management side of the MoneyBlock side. And I'm also very actively engaged with building out the retail side of Trading Block and really enhancing the product offerings that we have for the independent trader as well as the independent advisor. So pretty excited to be on with you guys and Randy and have a great discussion today.
Yeah, Joe, that's one of the reasons I really wanted to have you on the program this episode is because, your previous experience over there at Brokers Express, one of the few firms really detailed and really designed towards the audience for this program, the active advisor, the active asset manager who wanted a good platform to utilize options. And now you're transitioning over there to MoneyBlock, pretty much the only firm left really going after that audience in any real appreciable way. I know for a lot of our listeners, it's maybe the first time they're really hearing about MoneyBlock. Why don't you do a quick overview of what you guys are really bringing to the table, particularly for the advisors audience? I know you guys are really focusing on and targeting that audience and trying to offer them a lot of really cool tools and platform functionality to make it easier to do exactly what we talk about on this show, to help advisors utilize options and derivatives in some more compelling ways.
Yeah, Mark, and I think you hit the nail right on the head, which is, we're looking at advisors to offer them not only the execution tools and capabilities that they need to manage their business, but we're also showing them that if you're not incorporating other investment products and vehicles like derivatives, whether it's through options or futures, you're missing an opportunity that's going to A, differentiate yourself, and B, it's also going to allow you to outperform those benchmarks that you quite often as a manager will wrap yourselves around as far as performance is concerned. And so MoneyBlock is really focused on making that experience not only easy, but we also want to help evolve the traditional rep and the traditional investment advisor so that they can incorporate derivatives prudently. Randy was speaking to it, and you were saying in his introductory bio, these are unique funds. With what Randy's been doing, there are quite a few reps that were doing that at the Brokers Express and now at MoneyBlock. We took on a lot of those advisors, and now we're graduating a lot of advisors. So what we did really on the Options Express side, which was bubbling up the derivative product and giving them institutional style tools and capabilities for retail traders, we're now doing that for registered investment advisors here at MoneyBlock. So we're giving them the education, we're doing the compliance oversight, and most importantly, we're giving them the powerful platform execution capability so that they could do that for multiple accounts. And really, it allows the advisor to continue to do what they are really good at, which is meet the needs and objectives of their clients. And that's what we're accomplishing here at MoneyBlock, and we're looking to continue to build that out and revolutionize that.
And since the early days of Brokers Express, how would you say that this audience, the active advisor / asset manager who's interested or perhaps cognizant of options, how would you say that audience has evolved till now? Do you say when you go out now and talk to these advisors versus the early days of Brokers Express, do you think that audience is more receptive? Are they more knowledgeable of options? Are they more interested? Or do you think it's still pretty much the same and a very steep uphill road to climb?
No, I think that they're very receptive, especially since now, a very basic strategy like a covered right, where, a lot of clients will come in and say, well, you know what, I'm paying you a fee. And, first and foremost is when you go out and execute after I paid that fee, this portfolio, I'm already in a hole. So explain to me how you are adding value beyond just saying that you have proprietary analysis tools and capabilities that will get us in and out of positions more effectively than the general market. And really, the only tools that you can incorporate is something as simple as like a covered right, and doing that in an optimal format. And you're seeing not only funds that are revolved around covered rights, but now you're seeing that money managers are using that so that instead of doing a cover right on each one of their individual holdings, which could be costly, they're doing zero cost collars, beta weighted indices, like if they're beta weighted to the Russell 2000 or the S&Ps or to the NASDAQ, they're going in and doing zero cost collars based on the beta weight that they have for their portfolio. And you're seeing a ton of managers doing that. And I'm not just talking about the individuals that are doing that on 10 million or 25 million or $50 million books of business, which are quite a lot. But I'm talking about guys and gals that are doing that on billion-dollar portfolios. So it is really now not a matter of if you're going to use derivatives, it's you better be using them, because it's the only way that you're going to be able to do things like enhance a portfolio, reduce cost basis, and protect a portfolio so that you're going to meet the risk tolerances and objectives of your clients.
Joe, I couldn't agree with you more. That's really the reason we do this show, is to help educate and indeed motivate advisors to adopt these products and asset managers as well, and to utilize them in a responsible and valuable way to the clients. And I agree with you completely that I'm still amazed at the end of the day that more advisors aren't really rushing into these products. Because you're right, it is such a crowded environment. And if you're yet another guy out there who's just working for a big wirehouse and you're the corner advisor and someone comes into your office and you say, okay, how old are you? What's your risk tolerance? Okay, here you go, 60, 30, 10, or whatever the spreadsheet spits out at you. And that's the sole amount of value added you bring to the table. I really don't see how you're surviving in this competitive environment, short of the guy down the street is just too lazy to go anywhere else.
Mark, and I'll tell you right now, those big firms, the big box firms, they're not allowing them to do it anyways. You can incorporate the derivative strategy and component into a 60-30-10 model very easily. The problem is that the larger box firms, A, don't have the capabilities to manage the risk, and B, don't want to, because it doesn't meet their their benefits as a firm, because they make money on the spread, or however they make money is not based on the performance of their managers per se, but it's more along the lines of those client assets stay with the firm. And that's again another differentiator that we offer as a firm is that we offer the ability to do these strategies, and we offer them to do it in qualified and non-qualified accounts. Because there's going to be quite a few people as those assets start to trickle down, Mark, that don't have the ability to trade these types of strategies that Randy or myself or any one of the other advisors that we have here at MoneyBlock are able to transact, because they don't allow it in things like an IRA or some sort of non-qualified account that those firms don't allow you to incorporate options. So you just got to look at that when you're thinking about your advisor as well.
There's certainly a lot to get to, so I think without further ado, we should get to it and dive right on into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to our Options 101 segment. This is, of course, the portion of the show where we break down some basic options concepts and strategies and ideas and explain how you can incorporate them into your clients' portfolios. And we thought, what better topic to revisit on the program today than the topic that is pretty much being bandied about in every financial media outlet and every publication, anywhere you look these days. Doesn't matter if they're derivative-centric or not, they all seem to be hitting on it. That is, of course, the concept of the VIX being extremely low, of volatility in general being extremely low. That drumbeat is being hit upon in pretty much anywhere you look these days. And we thought it's really a good time to go back and address what that means from an option standpoint, as well as for you, the advisor who's looking to utilize options in those portfolios. And it has been a while since we touched on these topics here on the old program. We did a big overview of volatility and options pricing back in February of last year. So if you want to check that out in more detail, go download that episode, as well as an overview of the VIX itself in October of last year. So if you want a deep dive into either of those topics, then by all means, go check out those episodes in the archives and you'll get a full refresher, a full overview of all of those topics. But today we're going to do kind of a quick review of some of the key salient points when you're talking about volatility and when you're talking about VIX. Let's start off with the term itself. You probably heard this a lot, implied volatility being bandied about quite a bit. You remember from our conversation about this earlier, implied volatility is it sounds confusing, but it's really a very, very basic, very simple concept. That is, as of course we talked about on the show in the past, there are many components to an options price. One of those is indeed volatility. And when you look at the price of an option that is trading in the marketplace, let's say an option is trading for $5. When you start breaking out all of those different components of an options price, the extrinsic value, the time, the carry cost that's built into there, one of those values that you can pull out as well is the volatility. That is the level of volatility that the market is implying by that price. So it's essentially the level of volatility you can back out to in the prices that options are trading in the current marketplace. So it sounds very confusing, but at the end of the day, it's a very simple concept. Again, quick overview now. Go into it in those earlier programs in a lot more detail if you want to really break it down. And then, of course, there are various flavors of volatility. We, of course, have the implied, like we just talked about. That is the level of volatility that is being implied by the current prices of options that are trading in the marketplace, as well as what is called realized, or also called historical volatility. That is the actual level of volatility that the market has exhibited over whatever period you're looking at, 10 days, 30 days, whatever the case may be. That's the real actual volatility. So when you're looking at realized or historical volatility versus implied is generally going to be higher because that's the level the market's predicting, and the market never can really be sure. So there's always going to be some level of premium built into that implied volatility price that's known as the risk premium in the marketplace. You're always going to pay a little bit more for implied volatility versus what's actually trading in the marketplace. If those two levels get quite a bit out of whack, then there could be some interesting trading opportunities there as well. But in general, you're going to see usually a higher level of implied volatility than realized volatility in the marketplace. Now, Joe, we're talking about all these terms, implied volatility, realized volatility. Everyone out there right now is talking about how implied volatility is very low. If you're a financial advisor, you want to buy some puts, write some calls for your clients, or you're an asset manager looking at implementing options, what does this stuff really mean to them at the end of the day? Let's say if it's let's start off with the low volatility environment that everyone's talking about now, and then we'll transition to the high volatility environment. How does that really feed back into the day-to-day options trading that they're looking to do for their clients?
Well, strategically, it impacts it dramatically. And what I mean by that is that, for example, you brought up where an advisor might be looking to write premium to reduce cost basis or whatnot because they have either a neutral or slightly bullish sentiment. If you have a low implied volatility market, and specifically a low implied volatility market on the underlying that you're looking to write that call, what's basically going to be represented in that call that you're about to sell is if it has a low vol, is the fact that there isn't a lot of anticipation of big violent moves if it's low. So you're not going to get that, as you were mentioning, that component that's built into the option price, which is that the vega or extrinsic value that volatility represents in the option price. That's not going to be very large. So there's not a huge move being priced in as far as sharp, violent moves. It doesn't mean that the market cannot move directionally, as we've seen. So there's a challenge for premium sellers. For managers that are looking to buy options, you mentioned buying puts. The good part about low implied volatility is that you're buying options from a volatility perspective that are cheap, so that they're, the displayed percentage of potential movement for the year. And that's what really volatility represents. So Mark, let me give you an example. If you're looking at a $58 stock and it has an IV of 40, basically it's pricing in a 1-year standard deviation of about $23. And if that's low comparative to looking over the last 52 weeks, the bottom line is that if the trend that's in place, there isn't a heightened expectation of it potentially deviating from it. So you have to be very careful about your strategy selection. And that's what managers quite often run into is that they go in and say, well, I need to write premium because I want to take in some income. Well, it may not be the most optimal time because you're not getting paid for that. In other words, the amount of theta that you're receiving versus your vega risk is not there. So that if volatility did pop, you're going to get hurt on that, and you're going to miss out on an opportunity. Not necessarily hurt, but you're going to miss out on an opportunity, and you just need to be cognizant of that.
It's funny, I was reading an article, I believe it was in the Wall Street Journal just last week, and people were, again, pontificating about the low VIX environment, and they were talking to a variety of managers who were saying how they have to get creative in this environment. And one of them said, well, this is a very low volatility environment, so I have to be very creative. So this is when I start really writing a lot of premium to generate income. I thought to myself, wow, he has it a little bit backwards.
Exactly. And again, that's where, either they're getting a little bit nervous and they don't want to buy puts, which I'm advocating against neither of these, but I'm just saying that, again, you have to, implied volatility is just one of those barometers that helps you then go and use things like probability and other statistical analyses to look at, is this the most optimal strategy based on, your perspective of where the overall market's going. And you'll find, 9 times out of 10, that if you don't look at it from that perspective and you just do it out of just gut instinct or reaction, you're probably making a mistake.
Yeah, I would like to add my point to this discussion is that we look at it as a double-edged sword. So it is true that lower volatility implies that you'd be collecting less premium on a basis at that point. But the flip side, or the good side for us, is a firm that not only sells short-term volatility or premium, but we also buy long-term premium. So when income potential is not as high as it normally would be historically, it's also a cheaper time to potentially hedge your portfolio. So we always look at it as the good and bad side. And so this is an environment right now where we're not unhappy about hedging at this kind of level of volatility, even though it does affect somewhat our income possibilities.
Yeah, Randy, you guys are really a good example of, you're right, that double-edged sword of high or low volatility, because there really is no one right answer for that at the end of the day. You guys, for example, buy premium to hedge with your overlays, but you also have short legs. You have income components to that overlay as well. You're writing a call, and occasion you're also writing the out-of-the-money put, so legging into a put spread as well there. So you have 2 short legs and a long leg. So you have a vested interest on both sides of the fence. You want high vol for the income you're generating, but you also don't want to shell out a lot for the protection in and of itself. So that kind of comes back to this, probably the number one question we get on this show. In fact, I just got asked it again a couple hours before the show started, which is, if you're an options trader, I want to add options to my portfolio, what do I want? Do I want high vol? Do I want low vol? And that's why I wanted to get back to this conversation again, because we're hearing this question quite a bit again. It's really reared its ugly head again. And listeners, like Joe said, like Randy just said, there really is no one right answer. If you focus a lot on income generation strategies, you're probably going to want to lean on the higher end of the volatility spectrum within reason. Bear in mind, if things are off the charts and the S&P is flipping around like crazy, moving 3% a day, or underlying is moving quite a bit, you might probably want to dial back the option writing strategies strategies a little bit, or at least use risk mitigated strategies like spreads, and then vice versa when volatility is very low, then it probably is a good time to start looking at some long premium strategies and putting on protection that may otherwise be prohibitively expensive for you. A lot of other strategies become available to you in low volatility environments that otherwise wouldn't be attractive. So there is no one right answer to that question, listeners. It really depends on how you trade. And in general, both environments offer opportunities and they both offer challenges. So it really depends on how you look at it. Now let's move on to the product du jour, the one everyone's talking about when you start talking about volatility. That is, of course, the VIX. This is indeed the CBOE Volatility Index. We talked about implied volatility earlier. What the VIX really is at the end of the day, listeners, is just the implied volatility of the S&P 500 options that are trading over there on the CBOE. The front month at the money implied volatility. They add a few adjustments for it. Remember, we've talked about skew on this program in the past. They add a few adjustments for the out of the money options and some other things to adjust that value. But at the end of the day, it's really just the front month implied volatility there of the S&P 500 options, or the SPX options. Joe, probably the number one misconception we see with people who come to the VIX for the first time, whether they're retail or indeed whether they're professional advisors or asset managers who just aren't that familiar with this space, is the confusion between the spot VIX or the cash VIX and the actual VIX futures and what actually drives the pricing of the options they're in. How often do you encounter this when you're talking to new advisors in this space?
Oh, I mean, I've been encountering it since they've offered the VIX options every every year. But the reason why people are confused is because when they see that, what you said, the spot VIX or the cash VIX, as you refer to it as well, as you duly noted, that's just the front 2 months of the SPX options, and it's basically consolidating those VIX options and basically giving you roughly around a 30-day cash VIX. So, for example, if you looked at it, the VIX is right now at around 10 and some change. But then you look at the VIX futures and the VIX futures for July, right? Because that would be the expiration that we're looking at. The VIX futures for July are not trading at 10 and some change. They're actually trading at around 1260 or 1270. So you have that, and I hate to bring up these terms, but the term contango, where you see that the back months are actually trading at a premium to the front months. And the bottom line is that you're talking about volatility on the SPX, the cash settled index on the S&P 500 versus pure VIX. And that's where the confusion comes into play, where someone goes in and actually tries to trade the VIX options for the first time. And let's say that they bought some VIX puts because they thought it was going to go down, or they bought some VIX calls. And the VIX did what the VIX, the cash settled VIX, did what they thought it was going to do, which is go up or go down. And then they saw that their VIX options that they bought didn't do anything. And the reason why is because the options that they're looking at are trading off of the futures price and not off of that spot VIX that we hear on your show and other outlets or read in the newspaper. And once the advisor starts to understand that, and then we teach them little nuances, which is, instead of looking at the spot VIX, look at the look at the VIX options, right? And if you want to understand where those VIX options are actually pricing off of, or where that general price is, look at the closest at the money call and put, meaning the two strikes, the calls and puts that are basically trading almost at the same price. So, for example, if the spot VIX, right, the VIX is trading, you see it at 1050, go in and look at the July VIX options, for example. And right now, you would assume that the 1050 would be the at the money, or the $10 would be the at the money strike. It's not. Look at the same call and the same put in those VIX options. And as a matter of fact, if you looked at the $12 strike, you would see that the $12 calls are trading for about $1.50, and the $12 puts are trading for about $1.30. That's where, so somewhere around there. So the VIX, those options are not trading around 10.5. They're probably trading more around 12.5 or 1260. And so that's what we work with advisors to understand, what is this product pricing off of, and then they start making assessments about where they think volatility is going to go.
Getting into the deep waters, I like it there, Joe, with some synthetics love and some implied stuff. We've talked about that a little bit on the show in the past, listeners as well. If you want more in-depth talk about combos and things like that, and all that fun stuff, then by all means check out some of our earlier episodes here of Advisor's Option for a detailed breakdown of how to do exactly what Joe is talking about, how to find where the underlying is actually trading. Just looking at the options chain, it's a good little exercise to do on a regular basis to help refresh yourself on exactly how these products work and how they are priced. Now, Randy, like I said, we've been hearing this drumbeat quite a bit in a lot of outlets. The VIX is low. The VIX is low. Again, they're usually referring to the cash VIX, which, as Joe said, is trading somewhere in the 10 handle right now. Again, I'm an old school SPX guy, so for me, my frame of reference is a little bit different. To me, this isn't really that low. This is pretty much a normal from what I used to experience out there when I was in the pit on a regular basis. But we're hearing a lot of this drumbeat. Not only is the VIX low, but also that it has this long-term average of 20. And so volatility is a mean reverting asset. Get ready for the VIX to revert and perhaps revert aggressively back to around that 20 level sometime soon. What's your take, Randy, on that? That drumbeat of the VIX is low, the VIX is low. Do you feel we are in this is a very low level of VIX right now, or do you feel more perhaps that it's more of perhaps a normal level? And then also B, about this other concept of the long-term average of VIX being much higher and that we're due for a retracement sometime in the near future.
Well, I think it's hard to really argue with the long-term average of the VIX. It's much higher than it is right now, but that doesn't necessarily mean that it has to revert to the mean anytime in the near future. So that's always the biggest question of, even you could be right about your ultimate direction and not be right about your timing, which obviously wouldn't really benefit you from a trading perspective. So, I would argue, yes, I think it's a relatively low VIX, but it doesn't mean it can't hang around here for a substantial length of time going forward. And obviously, who really knows when it's going to revert? From our perspective, and this is where I think we are a little different in that we're not systematically or trying to go out there and try to make plays on where we think the VIX is going or not going. Our strategy is more based on a systematic approach of constantly hedging the portfolio and trying to generate income. So that, although I like to say that, yes, I think the VIX could go up substantially a lot over the next 6 to 12 months. I don't necessarily want to make that call or believe that's necessarily going to be what happens, but in our strategy as it's defined, we just kind of wait for whatever is going to happen ultimately to happen. So it's a lot harder to benefit from that potential play if you do think it's on either direction. Obviously, you can make money from making a bet that VIX is going to stay at this low level for an extended period of time, or it's going to mean reversion, go back to what it historically has. That's kind of my assessment.
And I'm glad you mentioned that we might linger around these levels for quite some time because that seems to be the one aspect that is missing in a lot of the broad coverage of VIX. They repeatedly mention that it could revert. It is mean reverting, and watch out for a big gap to the upside. But they don't mention exactly what you just said. We could very easily linger in this realm for quite a long time, these volatility levels. And so there is a very large carrying cost to these positions, listeners. If you are out there and thinking, well, I want to get in on this VIX train before it pops. I want to get my clients long some VIX calls or some VIX verticals, or perhaps I want to go out and perhaps, please don't do this, but perhaps I want to go out and buy VXX or something like that and get in on this pop. You're probably going to be waiting for quite some time, if not for quite a while, for VIX to do anything. So bear in mind that it is quite possible for us, all the other drumbeat aside, for VIX to stay at these levels for quite some time, and you can end up having to roll these positions for many, many consecutive months, or in the case of VXX, getting just completely destroyed from a term structure perspective. Again, we talked about that in a lot more detail on our VIX program. You can go download that, where we talk about term structure and how it really disadvantages a lot of these ETPs in the VIX realm. So at the end of the day here, the other big question we get when it comes in about VIX and volatility in general is, hey, should I be using this product as a hedge for my clients' portfolios? They hear a lot of talk about the VIX being inversely correlated to the S&P. They hear a lot of talk about VIX being a great hedge, et cetera, and they think, hey, maybe I should be doing this instead of buying an S&P put, particularly now that volatility is so low. I can get VIX at relatively low levels and get in ahead of this big mean reverting pop that it is destined for, quote unquote. And, we've advocated on the show in the past. I mean, particularly, we're not really huge fans of VIX as a hedge. I mean, we've talked in the past about the values of direct hedges like S&P put spreads for a portfolio versus the VIX options as a hedge. We're always going to probably lean on the more direct side of the fence because that is an actual hedge you can count on at the end of the day versus the VIX. Like Joe said earlier, there's days when the VIX is going to move in all sorts of weird ways that you may not expect. There are a lot of products out there pushing and pulling on the VIX in addition to just the implied volatility of the S&P 500, so that could have some interesting effects on the products. There's things like settlement. There's a lot of other gunk getting filled into that options price and that VIX performance that make it not exactly ideal as a hedge. That said, if you want to use it as a kicker for some of your direct spreads, your direct hedges, like let's say you buy a S&P put spread and then you have a little bit left over, you don't mind putting a little bit more on the volatility train in case you think it's going to pop in the near term, then a VIX vertical, something like that. Then you have that nice combo of a downside direct hedge with a nice VIX kicker in case volatility does indeed explode, because those are the few environments when VIX does indeed outperform a direct hedge. Those moments when volatility is aggressively moving, VIX tends to gap pretty aggressively, so you could capture that. And that's where our primary use case tends to fall when it comes to the VIX. Joe, how do you answer that question? You take the opposite side of that? Are you a big fan of VIX as a hedge? When these advisors come to you and ask you that question, where do you tend to steer them?
Well, you're taking a tactical approach to it. When I talk to advisors, I talk to them about how it's a more of a risk management tool or portfolio tool, because when you incorporate volatility into a portfolio, yes, ultimately you're incorporating it for some sort of, in this case, if we're looking for an event like a big pullback or something of that nature. But the one thing that I've talked with managers about is if you're going to incorporate VIX, you have to be prepared to actively manage that. And so whether you're using the SPX or you're using the VIX futures or whatnot, constructing it accordingly, appropriately, and then doing the appropriate portfolio management. In other words, you're going to have to look at the different cycles of how these things, will expire and move, and make the appropriate adjustments. It is something that has to be more actively managed, and that may not be in the wheelhouse of a lot of advisors. So that's why, here at MoneyBlock, we are actually working with advisors on an SMA side. So Randy could probably speak to this because I bet that they do this quite a bit, where they will put a portfolio together that will fit into a larger portfolio. In other words, as the proverbial put of the portfolio, and as long as it's actively managed, that volatility component of the portfolio, you're not going to see the dramatic swings that you normally would if you're just buying puts or selling premium in the SPX or buying, calls in the VIX or whatnot. You're going to see more of a balanced approach to how you're hedging your overall equity risk as far as your equity portfolio. And that's how I've been approaching our advisors and talking to other advisors about it and working with them. That's a portfolio tool, not just a pure hedging tool.
Well, Randy, we'll take us home then. What's your take on A, what Joe just said, and then B, wrap us up here on whether advisors should even be thinking about VIX as a hedging instrument, or if they should be leaning more towards, like we said earlier, more of the direct type products that you tend to utilize in your overlays?
Well, I think that at Swan, we definitely prefer the more direct approach. We think it's easier to, not only is it easier to probably implement in your program, but it's also easier to explain to your clients. Where I think there's proper uses of the VIX to hedge a portfolio, I think if you were taking a very, very small percentage of the portfolio and taking some of that kind of catastrophic volatility insurance out, I think it would be a good play. But as I said earlier, I like to rely on things that I can actually, it's more easily determinable how it's really going to play out. That's kind of my big overview. I always get back, going back to something we talked about a minute ago, I always look at the whole play of where VIX is really going and how long could it potentially stay low. Is that, to me, because our time frame is so much longer than a normal trade or maybe a 1 to 3 month cycle, we think that our product is ultimately structured in a way to be able to kind of wait out this game in terms of, and we like, quite frankly, starting out in a lower volatility environment and move into a higher volatility environment over time. Like I used the example in 1997 to into 99, 2000, where you really had a increase in volatility really for about 5 years. So I think the only thing I would caution when you are trying to hedge against volatility is you've got to have an approach that really takes into account that the cycle could take a lot longer to play out than what you normally would expect.
All right, great stuff. Listeners, of course, if you want to learn more about any of those topics, then check out the archives here of the Advisor's Option. If you really want to dive deep into the world of volatility, of course, check out our Volatility Views program that airs weekly here on the Options Insider Radio Network. And now we're going to keep on rolling right on into our next segment. It's time for The Buzz.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody, welcome to the Buzz segment. This is, of course, the portion where we break down some of the interesting headlines and stories and developments that we've seen over the past month that may interest you, the financial advisor, asset manager who's looking to add more options to their portfolios or for more ways to implement these products into their portfolios. Unfortunately, Eric and Alan from the OIC couldn't join us today, and I wish they were here to discuss this first story because I know this is right up their alley. I know those guys told me a while back that they were really focusing on this aspect of the market from a financial advisor and options perspective. And we saw a story coming out of Markets Media, our friends over there at Markets Media this past week, detailing exactly what they're going after, which is, of course, the headline was, "The Credit Unions Help Advisors Expand Their Use of Options." And it really explains and goes into detail about how these credit unions are a very untapped source of potential options clients and potential options users at the end of the day, because a lot of these credit unions have very large pools of members. A lot of them have substantial assets, first off, which is what a lot of advisors are looking for from a client perspective. And then B, from an options perspective, they're ideally suited because they also usually have large concentrated positions in a particular company. That's why these credit unions are usually founded. And so it represents a very interesting opportunity for the few advisors and asset managers out there who have this skill set to pursue. And this article is very lengthy. I won't go into the whole thing, listeners. I encourage you to check it out yourself. But they talk to a variety of different financial advisors who are targeting this audience. And one of them said, trying to get a managed call strategy absorbed by an older member of a credit union is difficult. My approach is to tell them to think of covered calls as a way of generating another 5 to 6% in additional income. You can outperform stock in a concentrated position by using these strategies. It starts with IBM stock, which is what the credit union they were referring to in the article was, and then invariably leads to a rollover. So it kind of just talks about what we've been talking about a lot here on the show in the past, listeners, looking for interesting new ways to implement this options knowledge and bring in some clients who may be ideally suited. Then I do encourage you to check out this article and indeed perhaps start exploring this aspect of the marketplace. Now, Randy and Joe, I'm sure this is not news to you guys. You guys have probably been targeting this area for some time. Maybe, Randy, we'll start with you. Have you guys done a lot of outreach to the credit union community, or is it something that's on your radar for going forward?
Yeah, I mean, right now we're getting a substantial increase just in the last month to 2 months of proposals that we're actually giving to different firms for companies and executives that have concentrated positions or single stock portfolios, or where a substantial portion of their net worth is tied up in that. So I think it's a trend that, quite frankly, it's in its infancy, and it's going to really grow a lot over the next decade or so. So yeah, it's a huge potential opportunity for Swan and other firms like Swan, and I guess firms that would support our managers and stuff like that, like Joe's firm that can really go out and really service these types of market opportunities. And of course, I always think that firms that are the smaller, more number ones are the ones that usually will take advantage of things like this a little easier. I mean, my fundamental belief is that smaller firms usually have most of the innovation.
And Joe, what about you? Are you guys actively pursuing this audience as a potential new audience for your advisor clients and potentially new audience for people coming onto your platforms?
Yeah, I mean, as a matter of fact, in 2006 and 2007, I traveled around the state of Wisconsin with Paul Ryan when I was with Options Express. We actually had agreements with credit unions in Wisconsin to take their HSA money because Paul was out promoting HSAs. we could actually house the HSA money, and we were the very strategy that we're talking about now that reps would execute for individuals that have high concentrations of securities, whether it's because they've had a job transition or whatnot. We were out there pitching that in 2007 for retail. So it is something that we here at MoneyBlock are working with our advisors and looking for that direct relationship with the credit unions, because as Randy said, there's a lot of opportunity, especially with individuals that are either transitioning or have an opportunity to move on to different experiences, but have a lot of their wealth concentrated, whether it's in one security or they're looking for a transition and more of a balanced approach. Looking to add something that's non-correlated to their equity strategy. We can talk to these individuals, work with them, and actually start to implement them. And they can understand that concept very quickly. Whether it's reducing cost basis or putting a non-correlated asset into their portfolio to balance it out in times of uncertainty, but still have that upside potential. And the credit unions like it, their clients like it, and we're moving into that space.
Yeah, like you said, you've been pursuing this space for quite a while. A lot of us here in the option space in general have been cognizant of this opportunity for a while. It's the first time I can recall any sort of significant outlet actually writing about it in these particular terms. So I thought that was interesting and worthy of note here on the old program. And I'm sure Eric and Alan, when they rejoin us in the next episode, will have a lot to mention about their initiatives and their forays into the credit union market. All right, and now since we're starting to run a little bit low on time, I want to make sure we get some time. We have some time for your questions as well. So let's roll right on into our final segment, the listener mail segment.
Listener mail. Listeners write in. Mailbox.
All right, everybody, welcome to the old listener mail segment. As the name implies, this is your opportunity to join us here on the Old Advisors Option Panel. Make your questions or comments known. A lot of great ways to do that. Like we said at the top of the show, you can, of course, use the app. You can leave a comment on our website there, theoptionsinsider.com. You can, of course, hit us up the old-fashioned way, questions at theoptionsinsider.com. Just be sure to put question for the Advisors Option in the subject line so we know which show to route your question to. Or you can find us on social media, twitter.com/options, facebook.com/theoptionsinsider. A lot of great ways for you guys to make your voices heard on the old program, just like our first listener did. This comes from Charlie Durant. He writes, Joe, this is the perfect one for you, so put your listening ears on. He writes, I love the Advisor show. Can you guys recommend a good tool or platform that will help me roll covered calls on my SPY and individual equity positions more effectively? Right now, I'm pretty much running a spreadsheet for my clients and then manually trading in and out of each position. Seems like there should be a better or an easier way? Well, that's a great question, Charlie. We do get variations on that theme quite a bit. Covered calls, obviously a very popular strategy for a lot of advisors out there and a lot of their clients as well. And of course, it is, as you're discovering, Charlie, a very labor-intensive strategy, particularly when you have a lot of clients, a lot of individual positions that you're rolling on a regular basis. Maybe you're writing the calls the way you're supposed to, taking advantage of that theta curve and writing nearer-term options. That means, of course, you're rolling the calls even more frequently. So it can become a lot of busy work if you're not really that well versed on it. It can take up a lot of time. So we get a lot of questions like this, Joe, about, hey, what are some good tools that can help me do this more effectively? I'd imagine you guys have baked a lot of this into the MoneyBlock platform. Would I be correct?
You are correct, and we're actually enhancing a tool that we'll be rolling out. We're looking to roll this tool out in probably third quarter, mid-third quarter, early fourth quarter. It's going to be an enhancement to our Trade Builder tool that will basically really show you the most optimal, in this case, look for that premium. But really, to answer his question quickly, it's probably one of his biggest challenges is allocation. In other words, loading up one trade and have it allocated in all his accounts on those rolls. We offer that right away with our group trade functionality, which allows a rep to do that. We have some enhancements that are going to be rolling out on that function. But Mark, there's some simple steps for Charlie to follow. One is basically you're looking to institute calls that have at least 45 days, no more than 40 to 50 days. As far as the vol curve is concerned, in this environment, it's going to be a challenge, but you're basically looking for about 1.5 standard deviation. And understand that the theta vega curve is so off right now, you're not going to get what you got maybe even 6 months ago as far as return. So with Charlie, basically, he's just going to have to be prudent about staying within that 45 to 60 day realm, and start thinking about rolling when he's getting into that 18 to 15 days until expiration of that short call. Those simple steps could help them kind of streamline it a little bit more. And then with the tools, we're going to be rolling those out in the upcoming months.
Yeah, all great points. And indeed, this is a challenging environment for anyone who's dependent on income generating strategies to continue to generate that income without, of course, messing up that risk reward equation by going too crazy, trying to scratch out every last bit of income you can get in this environment. Now, Randy, I know you guys over there at Swan went a little bit of a different road. You actually created some of your own proprietary tools to handle this stuff in-house. Do you think that's still necessary for a lot of the guys, or maybe some of the smaller advisors like Charlie, or do you think there's enough off-the-shelf functionality these days that Charlie should go that route instead?
No, actually, I think that the amount of product out there, Joe's firm like that sounds uniquely positioned to take advantage of stuff like that. I think that we do things, and some of the things that we do are a little different than most normal advisor firms. So I think the software is out there right now to be able to do those types of things pretty effectively. We've spent our time and energy really trying to maintain our portfolio. We manage about 3,000 SMAs right now, so really ours is about scaling up and be able to do large block trades and allocate and maintain proper allocations and percentages of different positions in a portfolio, knowing that you really can't review those on a regular basis without electronically doing that.
All right, great question, Charlie. We have time for one more here in the old listener mail segment. This one comes in from Firestar. I like the handle. And he or she writes, can I use VIX options in my IRA accounts, or are futures options banned due to leverage? We've discussed IRA accounts quite a bit on the show in the past. This is a very common question, not the VIX per se. That's a very timely component to this question. But the use of IRA accounts still seems to be problematic and confusing to a lot of the listeners out there. We talked in the past about how you can't do a naked short premium type strategies. You have to have, of course, the margin in your account to cover those. And of course, you can't use, but you can do a lot of these strategies you may like to use in your options account, like buy options and indeed covered calls, which are very attractive and very popular to a lot of our listeners. So a lot of the basic strategies we've recommended on the show in the past, collars, covered calls, protective puts, you can use those in your IRAs. We haven't gone down on a product-by-product basis in the past, so maybe it's time to do that now. Joe, what do you have to say here for our friend Mr. or Mrs. Firestar? Set them straight. Can they use VIX options in their IRA account?
Yes, I mean, VIX options are no different than SPX options. They're cash settled. So at the end of the day, you can. The only stipulation, like you said, is you can't do naked shorts, and because they're not qualified to do that. But you can do verticals, so you can do credit strategies because that risk is defined, and the options all expire in the same expiration month. What you also can't do in IRAs as far as VIX options are concerned, and obviously you have to have the appropriate level to do all of these strategies, and that's up to the brokerage firm to determine that. But the other thing, Mark, too, is that you cannot do calendar spreads in these cash settled indices. That is something that's industry wide, and that's just because of the risk parameters and the contango or contagion, whatever the situation is, that's revolved in what actually is delivered and what your risks are. It's just too difficult at this stage for clients to do that in a non-qualified account without having pretty substantial risk. So that's really the only limitations. Otherwise, yeah, go for it, Firestorm. If your firm doesn't allow it, either Trading Block or MoneyBlock, definitely come talk to us.
Yeah, like Joe said, the options are options at the end of the day. There are a few restrictions. You can't do one of our favorites, the old time collar, like we were talking about in the previous show, using these VIX products. It gets back to what Joe was saying about the contango risk there with some of these products and how they limit the calendars. But otherwise, all the strategies we've outlined in the past, the covered calls, protective puts, all those things, you can use them with the VIX options products. So great question there, Mr. or Mrs. Firestar, and great questions from all you guys. Wish we had more time. Maybe we'll do a whole listener mail episode coming up, but unfortunately that's all the time we have for the listener mail segment. That's also all the time we have for this episode of the Advisor's Option. But before we go, as always, let me check in with each of my cohorts here, my partners in crime on the old Advisor's Option panel. to see what they have coming down the pike. Since you were our guest this week, I'll give you pride of place. What's coming down the pike? What should listeners look forward to from you guys over there at MoneyBlock and indeed from Trading Block in the coming months?
So from a platform perspective, we're going to be rolling out a whole plethora of new tools and applications for the general platform from an interface. So we're going to be updating some activity or trade finder tools. The biggest thing that I can tell you, Mark, that we're going to be rolling out for advisors is going to be our execution platform. Our group trade enhancements, the group trade 2.0, as we call it, we're going to be putting that out in a beta side in the next 2 weeks. Those enhancements are going to allow any manager to be able to allocate to all of his client accounts, non-dependent upon what the strategy is. So whatever they want to implement, this tool will do it, and with real-time risk analytics built in, so that we're going to be able to understand buying power and so forth, and it's going to allocate right to the client accounts, which is great.
Great stuff. If they want to find that, where should they go?
So you want to go to moneyblock.com, or if you ever have any questions or you would like to get a walkthrough, just email us at support@moneyblock.com, support@moneyblock.com.
Great stuff. Glad you can make it on the program this week and join us here, Joe.
Thanks, Mark. I really appreciate it.
All right, and last but certainly not least, Randy, I know a lot of stuff is cooking in the land of Swan Wealth Advisors. Of course, you have the big shift to Puerto Rico. Perhaps that's more of a lifestyle beneficial thing, but of course, there's other things going on. With the mutual fund, you have Swan Re, a lot of irons in the fire over there at Swan. So tell our listeners what's coming on the pike. What can they look forward to from you guys over there at Swan Wealth Advisors?
Well, in addition to Swan Re starting to write premiums probably in the next week or two, that's actually one of the benefits of living in Puerto Rico from a tax perspective, because Swan Re is a Bermuda-based reinsurance company. You really can't do a lot of activities in the U.S., but that's one of the benefits of being in Puerto Rico now. But the two things on the horizon for Swan between now and the end of the year is that we expect to launch 2 new products. We have one of them will probably be a mutual fund, and we're going to take our defined risk strategy and apply it to an international equity venue, as well as we're looking at doing some type of hedge GLD gold product using the same fundamental strategy that we do on the S&P 500. So those are 2 new products that we hope to launch by the end of the year. We've been kind of finishing up our research and analysis and making final decisions probably in the next 30 days.
Well, the GLD one sounds particularly intriguing, especially right now. A lot of interest in GLD, that product moving like crazy. Obviously, volatility moving and dropping like crazy out there in that area as well. I think we're receiving more questions and comments about gold, particularly from a volatility perspective, than we ever have in the past. So a very interesting time to be launching an overlay product on GLD. I'll be looking forward to that one, Randy, when it gets into the marketplace, because I want to see how that one actually works out.
Yeah, the good thing about it is that we actually started our track record last year right before the big drop in gold. So we're pretty excited about that. The fundamental issues that we're dealing with right now is that because GLD is backed, or a similar product to GLD is can't really qualify as a mutual fund, or it's extremely difficult. So we're trying to figure out the best wrapper to put that in. So that's kind of one of the things that's holding up. But yeah, we absolutely are very excited about it, and we're super motivated to move forward on something like that.
Yeah, I guess you guys couldn't have had a better period from a pure promotional and marketing perspective than an extended drop in gold, because that's when something like your overlay strategy really outperforms. So that's been very, 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 very beneficial for you guys, I would think.
Yes, absolutely.
All right. And on behalf of Joe and Randy, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the program, and of course for sending in such great questions. Keep them coming, and we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.